Inflation in Australia has been too high for too long. This is behind the succession of interest rate hikes that the RBA has inflicted upon the Australian economy. It was the catalyst for the RBA hiking rates at its November Melbourne Cup meeting. However, now we have the October CPI data, and it's showing some positive signs. It's showing that inflation might be heading down toward target, albeit relatively slowly, with, for example, headline CPI inflation actually being negative month on month. So in this video, I'm going to be looking at that data and going through what's happening with inflation and looking at whether inflation might have peaked and whether we might get interest rate cuts on the horizon. And if you've got any thoughts about this, well, do let me know that in the comments below. So what was in the October CPI release? Now in October, CPI increased 4.9% year on year, which is still miles above what the RBA wants. However, it was vastly down on the prior reading of 5.6% year on year, suggesting some progress, albeit potentially with some blips month on month. This stands in contrast to the CPI release for the quarter, which was 5.4%. So what exactly is giving here? We've got a monthly reading and a quarterly reading. Why are the two different? Well, with the quarterly reading, it's incorporating 3 months into it rather than the monthly reading, which is just 1 month. Furthermore, the quarterly reading might have more of the individual components of CPI inflation updated for that reading as compared to the monthly reading, so you might get some discrepancies here and there. However, the monthly reading is still rather informative. Now, the year-on-year data lacks some nuance, like I've indicated. The year-on-year data incorporates a full year of data, and this can create myriad problems. For example, you might get base effects, which basically means that if inflation were really high or really low all the way a year ago, then that's going to feed through into your inflation year on year right now. Furthermore, it doesn't tell you much about the trajectory of inflation, really. For example, say inflation spiked 11 months ago and then tapered off. It will look like inflation increased quite significantly year on year, even though the more recent data suggests things are moderating. So the month-on-month data or quarter-on-quarter data is very informative, albeit with some blips and with some noise. Now, it is very interesting if we look at the month-on-month data. In the raw, non-seasonally adjusted data, CPI actually fell 0.33%. I'll repeat that, CPI fell month-on-month. That is deflation month-on-month. Although, one does need to bear in mind, this is just 1 month of data, not multiple months in a row. Now, if we exclude volatile items and holiday travel, CPI increased only 0.17%, which still, if you annualize that, is still within the RBA's target range. It still suggests good news. If we use seasonally adjusted figures, which adjust for the ordinary seasonal fluctuations that can go into CPI, for example, the end of school holidays or the beginning of school holidays, the beginning of Christmas shopping, that type of thing, well, CPI fell by 0.41% month on month. Again, a rather large decrease. All of this would be good news for the RBA if it were to continue on, because it would cause CPI to go back down toward where the RBA wants it to be. Now, underlying the decrease in CPI are some signs of economic weakness, signs of retail sales really struggling along, and consumers actually struggling under the weight of inflation and falling real wages. Now, while Michelle Bullock has remarked that consumers are strong and they're coping, I think that is perhaps a little bit too simplistic. For example, say you've got one arm in the oven and one arm in the freezer, well, then your average body temperature might look okay, but you are still kind of screwed. And that's the problem we're facing in the economy at the moment. You've got some savers who don't have mortgages who are perfectly okay, especially if they own their own house outright. However, you've got homeowners who have a mortgage, you've got landlords who have mortgages, you've got renters, all of whom are seeing their expenses go up significantly. And in particular for property holders, their interest expenses have gone up vastly more than the rent income could go up. The interest expenses have dwarfed that of their rental income. And therefore, a lot of people are struggling and we're getting a degree of bifurcation. And this has played into the retail sales data. If we're looking at the retail sales data, it shows us some economic damage. Now, to see this, we need to think about what happened to Australia's population. Well, Australia's population has increased about 2.5% over the past year. However, retail sales actually fell 0.2% month on month and only rose 1.2% year on year. So note that the population increased 2.5%, retail sales only increased 1.2%. That suggests that per capita sales might be struggling. And according to Robert Gottliebson, well, retail sales might have actually fallen about 6% year on year when you're factoring all of this in. That is, when you're factoring population growth retail sales actually declined. Now, that is telling in terms of the economic damage that we're suffering. It doesn't do much to alleviate inflation, because still if you get more and more people coming in and more demand, you still are going to have inflation, even though the amount of expenditure per person will have gone down. But it does tell us about something about the state of the consumer and the state of the economy. Now, what then can we infer from all of this data? Well, we can infer that the consumer appears to be struggling, we can infer that retail sales appear to be having some issues, and we can infer that inflation appears to be heading back down toward trend, albeit rather slowly, because consumers are struggling, which means that businesses can struggle to put up their prices, because consumers simply can't afford to pay anymore. And as a result, you end up with lower inflation. Notably, real wages have increased, well, they've actually decreased. Nominal wages have increased by less than inflation. And especially when you factor in what's happened with tax, when people are suffering from bracket creep, and the fact that if their wages go up 4.1%, their after-tax income has only gone up by less than that, for example. And therefore, you end up with a consumer that is really struggling at the moment. But this doesn't mean that inflation will automatically come back down. For example, we've still got population growth, we've still got the government going out and doing all manner of infrastructure spending, which isn't always very efficient, it isn't always creating very much economic value, it isn't always productive. So we're seeing a productivity lag potentially, and that government expenditure is also increasing inflation by driving up demand for materials, the demand for labor, and the demand for capital, which also in turn exacerbates housing supply issues because the cost of building housing has now gone up because of the government's own infrastructure spending, suggesting that inflation will struggle to come back down toward target imminently, but certainly it is heading in the right direction. Now, in terms of what this means for the RBA and interest rates, to my mind, it means that the RBA is less likely to hike rates another time. It appears extremely unlikely they'll hike at their December meeting. It appears unlikely they'll hike at their next meeting. However, sometime in 2024, we can optimistically hope for some interest rate cuts if inflation does start to behave, although the RBA is probably going to be very cautious about cutting rates, given the monumental struggle they've had to get inflation under control. So overall, this means inflation is showing progress, it's still too high, it's taking a long time to get back down toward target, the RBA is unlikely to hike rates another time, but nor are they likely to cut rates imminently. The next move is likely to be a cut, but that doesn't mean it's going to happen in the next month or the next couple of months. It might happen sometime in mid-2024 at this point. If you've got any thoughts about the state of the Australian economy, well, do let me know that in the comments below. And otherwise, thanks so much for tuning in. Hopefully the video has been informative to you. If it has, it would be great if you'd like the video and subscribe to the channel. And hopefully I'll see you next time as well.